February 6th, 2026. The day the silver market broke in half. While you slept, two prices existed for the same metal. COMEX in New York, $75 per ounce. Dubai's physical vaults, $127. The same silver, the same day, a 70% gap. Wall Street says market conditions, but here's what they won't tell you. Someone just proved the entire system is a lie. And the evidence? It's sitting in customs records they thought you'd never see. Welcome to Daily Silver Crisis. Now, I know you didn't get to 50 plus years of life by believing everything they tell you on the evening news, did you? So if you're the kind of person who wants the truth before it hits the headlines, hit that subscribe button right now. And do me a favor, drop a comment below. Where are you watching from today? New York? Texas? Maybe overseas? I want to know. Because what I'm about to show you affects every single one of us. Let's dig in. February 6th, 2026 marked the day when two different prices existed for the same ounce of silver at the exact same moment in time. In New York, at the COMEX exchange, silver settled at $75 per ounce. Traders watched their screens. The price seemed normal. Nothing unusual appeared in the official data, but 7,000 miles away, in the physical silver vaults of Dubai's gold souk, dealers were selling the same metal for $127 per ounce, same weight, same purity, same day. The gap was 70%. Anyone who has ever traded commodities knows something important. Price discovery is supposed to work. When a metal costs $75 in one market, someone should immediately buy it there and sell it for $127 somewhere else. This process is called arbitrage. It happens automatically. The price gap closes within minutes, sometimes seconds. But on February 6th, the gap did not close. It widened. For institutional analysts reviewing the settlement data that evening, a disturbing pattern became clear. This was not a temporary disruption. The divergence had been building for weeks. What made February 6th different was the size of the gap, and the fact that it occurred while both markets were openly operating. Normal premium spreads in silver markets run between 2 and 8%. These small differences account for transportation costs, insurance, and local demand variations. A 70% premium cannot be explained by shipping fees or regional preferences. The mathematics revealed something else entirely. If COMEX truly represented the accurate market price for silver, then every rational buyer would purchase contracts there at $75. No one would pay $127 in Dubai unless the COMEX price was unavailable to them, or unless they did not believe COMEX could actually deliver physical metal. Here is where the corporate contradiction emerged. The same financial institutions trading paper silver contracts on COMEX at $75 were simultaneously instructing their procurement divisions to acquire physical inventory through Middle Eastern intermediaries at $127. Their trading desks said one thing, their supply chain operations did another. JP Morgan's public statements during this period emphasized normal market conditions and temporary regional supply constraints. But their internal metal movements told a different story. Documented shipping records showed the bank redirecting physical silver allocations away from COMEX-registered warehouses toward private storage facilities in Singapore and Zurich. They were paying the premium, quietly. The business community needs to understand what this divergence actually means. In functional commodity markets, price discovery happens when buyers and sellers agree on value through transparent transactions. The price on the exchange reflects the price of actual metal available for delivery. When two radically different prices exist simultaneously, one of two things is true. Either the paper price is wrong or the physical price is wrong. Both cannot be correct. For the paper price to be accurate, billions of dollars in arbitrage opportunity would exist. Traders would flood into COMEX, buy contracts at $75, take delivery, and immediately sell physical metal in Dubai for $127. The profit would be automatic. The gap would close. This did not happen. The reason it did not happen reveals the core problem. Taking delivery from COMEX had become difficult. Not impossible, but difficult enough that institutional players preferred paying a 70% premium in physical markets rather than attempting to convert paper contracts into actual metal. The warning signs were visible in the inventory data. COMEX-registered silver stocks had been declining steadily since October 2025. By February 2026, the exchange held roughly 240 million ounces in registered vaults. But the total open interest in silver futures contracts represented claims on over 900 million ounces. The mathematics is simple. If even 30% of contract holders requested physical delivery, the available inventory would be exhausted. The exchange knew this. The large institutional traders knew this. The regulators monitoring the market knew this. And on February 6, 2026, the price divergence made it public knowledge. This is not volatility. This is not speculation. This is documented evidence that two separate markets are operating under fundamentally different assumptions about whether physical silver actually backs the paper contracts being traded. The strategic question facing serious investors is no longer about price predictions or market timing. The question is whether the paper silver market represents exposure to metal, or exposure to institutional promises about metal that may not exist in the quantities claimed. February 6th provided the answer. The 70% gap they cannot explain is the evidence they cannot hide. The institutional response pattern. When the 70% price gap became undeniable on February 6th, something interesting happened in the following 48 hours. The gap did not close, but the conversation about it did. Within 3 days, the institutional response machine had activated across multiple coordinated channels. What they said publicly and what they did privately revealed two completely different strategies. Bloomberg published their analysis on February 9th. The headline read, "Silver Premiums Rise on Regional Supply Constraints." The article mentioned Dubai pricing briefly, attributed the difference to logistical challenges in Middle Eastern markets, and dedicated most of its word count to interviewing COMEX floor traders about normal volatility patterns. Reuters covered it similarly. Their piece focused on temporary disruptions in refining capacity and quoted 3 anonymous sources from major bullion banks. All 3 used nearly identical language. Market participants should expect normalization within the quarter. CNBC brought on a precious metals analyst from a large investment bank. He spent 6 minutes explaining why retail investors should avoid panic selling and trust the institutional pricing mechanisms. He did not mention that his own firm had just redirected 4 million ounces of physical silver away from COMEX warehouses to private Swiss storage. The media narrative was consistent. This is temporary. This is regional. This is not systemic. But the customs documentation told a different story. Between February 7th and February 14th, shipping manifests showed a dramatic increase in silver movements from London vaults to non-COMEX facilities in Singapore, Dubai, and Hong Kong. These were not small retail transactions. These were institutional-scale allocations, ranging from 500,000 to 2 million ounces per shipment. The metal was leaving the official exchange system entirely. While financial journalists were publishing reassurances about temporary premiums, the institutions writing those statements were simultaneously securing physical inventory at those same premium prices they publicly dismissed as anomalies. The regulatory response was equally revealing, through its silence. The Commodity Futures Trading Commission, the agency responsible for monitoring derivative markets for manipulation and systemic risk, issued no public statements about the price divergence. No emergency meetings were announced, no investigations were opened, no position limit reviews were initiated. This silence was not accidental. It was strategic. A historical comparison clarifies why. In March 1980, when the Hunt brothers attempted to corner the silver market, the CFTC responded within days. Emergency position limits were imposed. Trading was halted. Congressional hearings were scheduled. The regulatory apparatus moved decisively because the threat was external manipulation by private actors. But in February 2026, the threat was different. The price divergence was not caused by external manipulation. It was caused by internal structural problems within the derivative system itself. The paper contracts had exceeded the physical supply available to back them. Regulators cannot fix that problem with position limits or emergency trading halts. Acknowledging the problem publicly would trigger the exact delivery demands that would expose the supply shortage, so they stayed silent. Meanwhile, COMEX made quiet adjustments to contract settlement procedures. On February 11th, new language appeared in the delivery specifications for March contracts. The changes were technical, buried in administrative updates that most retail traders never read. The modifications gave the exchange greater flexibility in determining acceptable delivery points and expanded the definition of force majeure events that could justify settlement delays. These were not changes made for clarity. These were changes made to create legal protection against delivery failures. The pattern becomes clear when examined systematically. This was not an uncoordinated response. This was institutional crisis management. The media controlled the narrative for retail investors. Tell them it is temporary, tell them it is regional, tell them the institutions have everything under control. The regulators provided cover through silence. No investigations mean no official acknowledgement of systemic problems. No official acknowledgement means no legal liability for institutions that cannot fulfill delivery obligations. The exchanges modified the rules to protect themselves legally when deliveries fail or get delayed beyond contractual terms. And the institutions themselves secured physical metal at premium prices while publicly stating those premiums were irrational. This is not how markets behave during temporary supply disruptions. This is how institutions behave when they know something fundamental has broken and they are managing the pace at which the public discovers it. The Hunt Brothers crisis in 1980 was about external actors trying to manipulate prices upward through cornering supply. The response was aggressive and public because stopping external manipulation protects market integrity. The 2026 silver crisis is about internal structural failure, where paper claims exceed physical supply. The response is defensive and quiet because acknowledging internal failure destroys market credibility. February 6th was not the moment the system broke. February 6th was the moment the evidence became too obvious to hide from anyone analyzing public market data with institutional level rigor. The institutions managing this crisis are not trying to close the 70% gap. They are trying to manage how quickly retail investors realize what that gap actually means, and that management strategy tells you everything you need to know about what they believe comes next. The mathematical endgame and strategic implications. There is a number that matters more than any price chart or market commentary. It is a simple calculation that reveals why the current situation cannot continue indefinitely. Total open interest in COMEX silver futures contracts represents claims on approximately 900 million ounces of physical silver. The registered inventory available for delivery at COMEX warehouses contains roughly 240 million ounces. 900 million ounces claimed, 240 million ounces available. The ratio is 3.75 to 1. This means that for every ounce of physical silver actually sitting in registered vaults, there are 3.75 paper claims against it. If even 27% of contract holders requested physical delivery simultaneously, the available inventory would be completely exhausted. This is not speculation. This is documented exchange data available to anyone who reviews COMEX inventory reports. The strategic question becomes, how long can a market maintain a 70% price divergence when the paper-to-physical ratio is 3.75 to 1? History provides guidance on this timeline, though the precedents are not reassuring. In 1971, when the London gold pool collapsed, the divergence between official gold prices and physical market prices reached approximately 40% before the system broke. The breakdown happened over 18 months. Once the gap exceeded 35%, the acceleration toward collapse took less than 90 days. In 1980, the silver market experienced forced liquidation when delivery demands exceeded available supply by a ratio of approximately 2.5 to 1. The price collapsed from $50 to $11 in 4 months, but the collapse was not caused by reduced demand. It was caused by regulatory intervention that prevented physical delivery, forcing contract holders to settle in cash at artificially suppressed prices. The current situation differs in critical ways. The 2026 divergence is not being driven by speculative excess or attempted market corners. It is being driven by actual supply constraints created by geopolitical export restrictions and decades of derivative expansion that exceeded physical metal production. China's January 2026 policy restricting silver exports affects 70% of global refined silver supply. This is not a temporary trade dispute. This is strategic commodity control by the world's dominant refining nation. When a government controlling 70% of refined supply restricts exports, the physical market price reflects actual scarcity. The paper market price reflects institutional reluctance to acknowledge that scarcity publicly. The divergence will resolve. The only question is how. There are two possible scenarios. Scenario 1, paper contracts converge upward to physical market prices. This would require COMEX silver to rise from $75 to match Dubai's $127. For this to happen, the exchange would need to demonstrate that adequate physical supply exists to back all outstanding contracts. Given current inventory levels and Chinese export restrictions, this scenario requires either massive new supply sources or dramatic reduction in open interest through forced contract liquidation. Scenario 2. Physical prices converge downward to paper market prices. This would require Dubai, Shanghai, and Singapore dealers to accept that their $127 metal is actually worth only $75. For this to happen, the supply constraints would need to disappear immediately. Chinese export policy would need to reverse, refining capacity would need to surge, and institutional buyers would need to stop paying premiums for physical allocation. One of these scenarios requires a complete reversal of geopolitical commodity policy and global supply conditions. The other requires acknowledgement that paper derivatives have exceeded physical backing. The institutions positioning themselves right now have already made their decision about which scenario is more likely. Documented shipping records show continued physical accumulation at premium prices by the same banks that manage COMEX trading operations. They are not waiting for convergence. They are securing metal before the paper market acknowledges reality. Central bank data reveals increased precious metals allocation across multiple sovereign entities. These are not retail investors chasing momentum. These are institutional decision makers with access to supply chain intelligence making long-term strategic positioning choices. The question for serious capital allocators is not whether to participate in silver markets. The question is, what kind of exposure actually represents strategic value? Paper derivative contracts offer leverage, liquidity, and ease of entry. But they also offer counterparty risk, settlement uncertainty, and exposure to regulatory intervention that can modify contract terms retroactively. Physical metal offers no leverage, lower liquidity, and higher storage costs. But it also offers no counterparty risk, no settlement dependency, and immunity from regulatory contract modifications. February 6th was not the crisis. February 6th was the day the evidence became undeniable. The 70% gap exists because two different realities are operating simultaneously. The paper reality assumes adequate supply and normal delivery mechanisms. The physical reality operates under confirmed supply constraints and institutional competition for available inventory. When price discovery fails at this scale, markets do not gradually adjust through small incremental changes. They reset violently through forced reconciliation events. The institutions cannot close the gap because closing it requires either acquiring physical metal that does not exist in sufficient quantities or acknowledging publicly that their paper contracts exceed deliverable supply. Both options destroy the current system's credibility. So they manage the gap. They control the narrative, they modify settlement terms, they secure private physical allocation while telling retail investors the premium is irrational, and they wait. But mathematical realities do not wait indefinitely. A 3.75 to 1 paper-to-physical ratio cannot sustain a 70% price divergence forever. The timeline for resolution is unknown, but the direction of resolution is calculable. The data is public. The implications are clear. What remains is individual strategic decision-making based on whether one believes paper contracts will converge to physical reality or whether physical reality will expose paper contracts as the largest institutional failure in commodity market history. The 70% gap they cannot explain today becomes the evidence they cannot deny tomorrow.